Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Chris Vermeulen from TheTechnicalTraders.com. Welcome back to the show, Chris.
Thanks for having me, Jim.
Chris, the price of gold jumped quite sharply today. Do you have anything behind that?
Well, gold's been on a tear the last really almost 3 months already. It's found a nice bottom in March, and it's been making a stair-stepping action, a bunch of bull flags to the upside. It's definitely being seen as a defensive, kind of a safe haven play right now. And you and I talked about this a couple of weeks ago that I think the precious metals sector is on the verge of a much bigger run. I mean, we've seen a nice move in gold, but I think it's actually going to be taking a run at that $2,000 mark, potentially break out and go for a much bigger run up to around $2,700 an ounce going forward. So I think there's a lot of upside potential. And obviously we're seeing some concerns with Bitcoin getting kind of blocked and shut down in Asia. Obviously, some of that money is people are going to start to second guess Bitcoin to some extent. And if Asians can't buy Bitcoin, they may want to start to move back into gold because they do like precious metals. So I think that's definitely helping lift the price of gold here going forward.
Now, I just had a discussion with Rick Ackerman about physical versus paper gold. Will you want to make sure you have real gold, as I call it, the physical stuff somewhere where either you hold it or somebody else is holding it, but you know it's there for sure and it's not just a certificate that claims that you have gold?
Yeah, I think for sure. I mean, if you're an active trader, I think paper gold's fine to get in and actively trade, you know, the ETFs around gold and silver, things like that, because you can quickly liquidate and get out. But I mean, if there's going to be some big chaos in the future, and you want to hold large amounts in precious metals, then you definitely want to go physical. Pay that small little, storage fee somewhere outside the banking system, outside the financial system, and have it there because. When push comes to shove, you may own it on paper, but if somebody doesn't have it to deliver it to you, you don't really own it. So I do not trust the paper system as far as you can throw it.
Now, when it comes to storage, that's why some people don't like gold is you have to pay to store it, whereas if you hold some kind of other financial certificate, you get paid interest and so on. Or is gold going to go up high enough that you don't have to worry about the payment, the storage fees?
I wouldn't look at the storage fees as too big of a deal. I mean, I think it's a big deterrent for a lot of people. Just naturally, they don't want to have to pay money to have it stored there. But when you own the ETFs, there's a fee to have those. And really, it's almost the same price, if not more, than having it stored at some type of vault. I mean, it's very cheap to have it stored. It's like 1/3% or 0.5% storage maximum. So it's a very small fee. In fact, it's probably less than holding an ETF on it. So, people also are concerned about, you got to store it, you've got to move it, you've got to deliver it, and how are you going to sell it? And they're all viable, questions and concerns. But if you're with the right storage company, I use Sprott Money, and it's pretty straightforward. You can deposit it, you can buy it from them, deposit it straight in there. You don't have to touch it. If you ever want to sell it, you're one quick call away and they will liquidate it and remove it for you. So it's pretty easy. It's almost as easy as trading. It takes a couple more little steps, but you got the real thing going for you.
Now, of course, we always pay the most attention to gold. What's going on with silver?
Yeah, well, silver continues to perform really well. It's holding up a lot better than gold. Silver's testing up near the highs that we saw back in February and way back in August of last year. So it's been trading sideways in this big pattern. It's on the verge of breaking out. The whole precious metal sector is on a verge. And I think if we see silver break out here, it's going to pop. It's going to run to about $34 or $36 an ounce very quickly. Current price is $28.32 with the continuous futures contract. So there's some pretty good upside potential in silver. More or less, it's got the strongest pattern in terms of the precious metals sector. It's held up the best, while gold and gold miners sold off in a pretty significant way. And usually whatever group of stocks or commodities hold up the best, when the perfect environment, the perfect storm actually brews, those ones are the ones that take off and leave everything behind in the dust and outperform. So I like silver a lot. I like the silver miners as well.
I was just going to ask about the miners. They've been beaten up so severely for so long. Why have they been ignored when, people keep saying there's this huge upside for gold and silver? Well, what about the producers? Won't they be major winners here, considering that they've cut their production to the most efficient production ever? Their costs have gone way down.
Yeah, I mean, the markets don't always move. If everyone's saying the same thing and feeling the same thing, the markets generally go against it. And a lot of times, the stock market rallies on this giant wall of worry. Nothing makes sense. We're in a recession and COVID. I mean, we saw the strongest stock market rally ever last year. It's pretty amazing. It goes against every bone in your body. Same with the gold miners. Obviously, they had a big, long, deep correction the last 8 months or so. Selling off, and yet everyone talks about, precious metals are going to the moon. So why wouldn't the gold miners, the producers, all these companies be skyrocketing? It's just the way they move. When you look at the miners, silver miners are definitely holding up the best. They're on the verge of a big breakout, a big rally, and I think they're going to move the most. I mean, there's a lot of talk still about, the big silver squeeze eventually someday, and if that does happen, you're going to want to be in silver miners. It's going to be the best of the best. So I like them. I like silver miners again, better than gold miners, because they're already on the verge of breaking out to some new multi-year highs, whereas gold miners are a long ways down. They got to really dig themselves out of this big hole, or climb out of the hole that they dug over the last 8 months.
We'll have more with Chris Vermeulen right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine, situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration, with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Chris Vermeulen. Chris, Bitcoin is in trouble, or is it?
It's definitely in trouble. I mean, it was showing signs of weakness about a month ago when it had a big breakdown in late April, and then really struggled to rally back to new highs. It formed what was a big bear flag pattern, and it rolled over, and then it crashed and burned. And I mean, we saw it fall roughly about 54% from the high in April to the low in May, and it's continuing to struggle. Now, Bitcoin, I mean, it's still in a major super cycle to the upside, but it's definitely the wind's been taken out of its sails. If you go back in time, all the way back to 2010, Bitcoin has had these big parabolic rallies that we've seen this year, where it just has some explosive move, goes up hundreds of percent. And then it corrects. And 6 times in the past, we've seen it correct 65 to 93%. The average is about 73% correction. Bitcoin so far has only corrected 54%. So for it to just get into the average, I mean, it still needs to drop another at least 10 to 20% to the downside before it's going to fall in line with past volatility that it's shown. So it's a wild ride. I think, I mean, most people are super bullish on it, And I am as well, but I think it's going to be out of favor. It's going to take several months before it can climb its way out of this, based on the chart pattern and how it's sold off. We'll have to just see how quickly it can get out of here, but based on the patterns, I mean, we're looking at probably another 8-12 months anyway before it really builds a new platform and starts another major bull market rally.
Getting back to precious metals, what about palladium and platinum?
Yeah, they're up the most today. We're looking at them. They're both up over 1.5%. Platinum's been trading sideways since February, kind of taking a big consolidation. Overall, it's a bullish consolidation. It looks like it wants to eventually break higher and start to have a run. Pretty much the whole precious metal sector has been fairly dormant. When we look at palladium, obviously it's had a bit more of a run. Simply, it's got some different uses, and it's starting to pull back and correct. But it broke to some multi-year highs or all-time highs here just in the past month and a half, and it's having a quick pullback and correction. It's going to be really interesting to see where it goes going forward. It's in a strong uptrend. It's at support as we speak. It hit 3,000 and pulled back, and 3,000 is a technical level. That's a whole number where traders, when they see a number like that, they say, hey, if it hits $3,000, I'm selling my palladium. It's just one of those levels, and that's what happened. It hit 3,000. It's rolled over. There's been some profit taking going on, and I think it's going to trade sideways for a couple of months here before it builds up a base before it goes higher. And then I think it's going to be heading up to around 3,400 from where it is right now, which is currently 2,700. So all the precious metals are looking really good. You look at platinum and palladium, they've actually been holding up very well, better than gold. Gold's actually one of the worst of them all, believe it or not. And that's just the way the markets move. It's the one that everyone's watching and wanting to move is the one that typically struggles. And it's the other ones that start to outperform and have more upside potential. And that's why we've seen the silver miners outperform, and platinum and palladium have actually been holding up very well going forward. And that's because most people don't watch them, but there's money just slowly going into those, driving the prices higher.
What's going on in the commodity market?
Well, commodities as a whole are doing exceptionally well. We've just been seeing them rally up. We've seen the lumber market, the softs, the grains especially just really taking off. And generally what we see are commodities perform very well near the end of a stock market bull market. And so that's kind of where we're getting at now. And typically we see gold miners break out and have these big runs 1 to 2 months before a stock market correction. And commodities typically do the same. We're seeing crude oil move up. A lot of commodities have been moving up. And so this is a kind of a warning sign to me that we got to be aware that the stock market may be on its last legs for a little bit, and then we're going to see a much deeper correction. I think the SP 500 could pull back 15 to 20% this summer. I think that's not out of the question. I think it's a very high probability. And we're going to start to see more warning signs. Commodities are rallying in general over the past several months, and we're seeing bonds starting to put in a bottom. If bonds start to rally in a big way, that to me is going to be a big red flag saying, okay, big money's moving into bonds or driving the bond market higher, and they are trying to get protective because they are unloading shares, which generally will trigger the start of a sell-off. And then once the selling starts, everyone jumps on board, and it'll create a much deeper correction. This stock market is very frothy, and people are very jumpy. So when it starts to roll over, we're going to probably see a very sharp collapse. And I don't think it's going to start a bear market. I think it's going to start more or less a big multi-month consolidation that could take 5-6 months to get out of it. And from there, we need to see if it's creating a massive bear market pattern, a bear flag on the chart for how we look going forward. But at this point, it's frothy. Got to be aware that this rally is starting to run out of steam. More than half the sectors are in a short-term downtrend, so the stock market's rising with fewer stocks supporting it. That's never a good sign. So there's a lot of little warning signs out there, but you don't want to bet against the market yet. You got to wait until the trend is in favor, which would be a downtrend, and then you can potentially profit from falling prices. But trying to pick a top is a deadly game.
Chris, what have you seen happen to people who are, as I call them, top pickers?
Well, yeah, they typically don't last long. People who pick tops are generally somebody who's also tried to pick a bottom, and both of them are extremely deadly. Typically, when you're trying to pick a bottom, it's during some big, high emotion, high volatility kind of sell-off, and the bottom usually drops out. You know, they think they got the bottom, it drops out. And sometimes the worst thing about trying to pick a top or a bottom is that when you do get it right, you can make a ton of money. The problem is the odds are against you, and it's not even a 50-50 coin toss. It's typically you're betting against, the odds are dramatically against you. But you get addicted to that grand slam that you just nailed and made a lot of money on that top, or a bunch from an oversold sell-off, rallying back very quickly. And so suddenly people think that that's a strategy and that it should be done and that they can do it. And so that's the problem, is you only have to land one of those big winners and you start to do it more often. But you'll see after a while that those traders just, they grind their account out, they end up losing money, they end up with these massive positions that are in such big losses that they don't even want to sell them because it's almost worthless at that point. So you got to be really cautious. Picking a top or a bottom is just a sucker's game. The markets can just keep moving longer than you can keep that position. It'll go to zero because most people use leverage, especially when they're trying to short the market with the top. They want to get real fancy and try and make a fortune, but it's a very deadly game to play, and it teaches you really bad habits. If you win one of them, it's the worst thing you could do is trying to pick a bottom or top and then win big, because it'll taint you for life if you can't get some rules in place.
Margins are at a record high. What does that mean if the market decides to correct in a few months?
Well, that's it. I mean, we're seeing everyone borrow money to buy stocks in Bitcoin. We saw the big margin unwinding in Bitcoin. I mean, it was like record high, people borrowing money. And when it starts to unwind, it goes into this very, very sharp collapse. A lot like we saw back in with the COVID crash in 2020. It's going to create huge red bars, very violent, very quickly. I mean, if you're not on the ball, you don't have stops in place or rules to get you out as things are falling, a blink of an eye and it's almost too late to get out because so much damage happens. It's going to be a high volume sell-off event that happens, over a 1 to 2 week window. That'll be quicker than most people can imagine. Unwinding leverage is very, very powerful and swift. So that's what people need to realize, is you need to have some type of protective stop in place, rules, because the market can drop 5, 6, 7% in a day. We've seen it happen. Intraday swings, we see the stock market sell off 2 or 3%, in the morning or in an afternoon, and then rally back 2 or 3% the other way. We're seeing these 5, 6, 7% swings during these big volatility days, and people just don't realize that there's a lot of risk here, and margin, borrowed money, when it has to unwind, I mean, it creates a real feeding frenzy because everyone pretty much has to do it at the same time. Things reach certain thresholds, and it's when everyone runs for the same door, it creates a bottleneck, it creates huge selling pressure that there's just not nearly enough buyers out there, and so the price just free falls and collapses.
What do you see happening with interest rates?
Well, I think interest rates, I mean, they're talking about potentially raising rates here, and we're seeing the 10-year yield has been holding up and showing there's some real fear there. I think if rates do start to go up, it's going to put a lot of pressure on the stock market. I think there's quite a bit of risk at the stock market at this level here at this moment. And if rates go up, people are going to naturally want to potentially get into some lower risk plays and just kind of be happy with where they are financially until, the markets kind of settle out or something like that. So it's going to be, if the rates start to go up, I think we're going to see some pressure on commodities, because, say if the U.S. dollar increases rates, generally we're going to see the currency go up. People move their money to currencies that have higher interest rates. The dollar rises, it's going to put pressure on commodities, precious metals, and it would make sense because the U.S. dollar index is trading down near long-term support. And so it's naturally at support. If the interest rates start to rise, the dollar could have a very strong bounce, and that will take the wind out of precious metals for a little while, and continue for them to base out for several more months here. So it'll be interesting to see how that plays out. Overall in the markets, we're really just got to be very, very defensive. We're sitting in cash as a short-term trader right now because the markets are mixed. We're waiting for confirmation of a new uptrend in the stock market. And if it continues to trade sideways or lower, we won't be involved. But so right now we are very defensive, sitting in cash. Not even bonds are a good play at this point. They're not even acting as a safe haven. So cash is kind of king at the moment.
Chris, thank you so much for chatting with us.
Hey, thanks for having me, Jim. Always a pleasure.
My guest has been Chris Vermeulen from thetechnicaltraders.com. If you have any questions for Chris or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. We're on Facebook, our YouTube channel, Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.